Imagine you're at a concert. The music stops suddenly. You don't see or hear anything unusual, but the crowd starts moving toward the exits. You follow, right? Not because you know something, but because it feels safer than standing still. Now apply that instinct to your investments. Maybe you sold during a downturn because everyone else was, or jumped on a hot stock because it was all over your feed. That's not strategy, that's herd mentality. And it's one of the most powerful forces in investing because it feels safe, but it can quietly lead you in the wrong direction. Let's talk about it. Hey everyone, welcome to this week's episode of From Wall Street to Your Street, and I'm glad you're here today. I'm your host, Ryan Flanders. Probably know by now that I used to be a coach, but before that, I was a student of economics. And later, I earned my CFA charter. I've spent my career combining what I learned in the classroom and in the markets with what I learned on the field, and that's how to lead, how to teach, and how to help people perform under pressure. Today, I use that same mindset to coach investors through the emotional ups and downs of building wealth, because it's not just about strategy, it's about behavior. Each week, we break down a behavioral bias that quietly influences how we think about money and how to make better, more grounded decisions. This week, we're diving into herd mentality, what it is, how it shows up, and why it's such a difficult habit to break. Herd mentality is our instinct to follow the crowd, especially when we're uncertain. In everyday life, this often works. If everyone's avoiding an exit, maybe the traffic really is bad ahead. If everyone's piling into a restaurant, maybe it really is that good. But investing is different, and this instinct, it can be dangerous. You see it in things like an investor buys into a hot stock just because it's trending, or people sell their portfolios when the market dips, not based on their plan, but on headlines. Sometimes friends will copy what they saw work for someone else online, assuming it's going to work for them too. When enough people start doing the same thing, we think, oh, maybe they're onto something. But in the market, the crowd is often a few steps late. Think back to March 2020. COVID hits. Panic spreads. The market drops over 30% in just a few weeks. Headlines scream recession. Everyone is selling. Moving to cash, saying, I'll just wait until things settle back down. But guess what? The market started recovering in April. By the end of the year, the equity markets were back in the green, most of them substantially so. Investors who followed the herd locked in losses. Those who followed their plan, they recovered, and then some. Let's go a little deeper here. Herd mentality isn't just about following others, it's about why we follow them. And usually it comes down to just two emotions, fear and greed. These are the twin engines of every market cycle. And when the market's rising, greed kicks in. You hear success stories. Your coworker doubled their money in crypto, or your friend can't stop talking about a new hot fund that they invested in. You don't want to miss out, so you jump in. Maybe without even understanding the risk. That's FOMO, plain and simple. Then something shifts. The market dips, a scary headline pops, and just like that, greed turns into fear. People rush to sell, protect what's left. Just get me out, they say. And you follow. Because everyone seems to be doing it. And that's the trap. Let me show you this cycle in action, both sides of it. The first example we've already talked about already. That was the COVID crash of 2020. The pandemic hits, uncertainty explodes, and the market tanks. People panic sell, and then they sit in cash. But within 60 days, yes, 60 days, the markets began recovering. By December, the S&P 500 was up double digits for the year. Those who stayed invested saw that rebound. Those who sold with the herd, they missed their opportunity. Not long after that, the meme stock mania of 2021. GameStop, AMC, and others skyrocketed. Social media hyped it up, and retail investors rushed in. Why? Well, because everyone else was doing it. The fear wasn't losing money, it was missing out on earning money. But fundamentals didn't matter. And eventually that hype faded, and many of those investors who had bought in were left holding the bag. Crypto, AI stocks, tech rallies, tariff pullbacks, even election-driven volatility. The headlines change, the pattern doesn't. When markets rise, we want in, which means we buy high. When markets fall, we want out, which means we sell low. That's the opposite of what investing is meant to be. We don't want to buy high and sell low, but too often we're following the crowd and not our plan. By the time it feels safe to invest, the opportunity is past. By the time we're scared enough to sell, the worst is usually over. The best investors aren't the ones who never feel fear or greed. They're the ones who recognize that they have these emotions and they build guardrails around them. They do things like stick to a long-term strategy, even when the noise gets loud. They use data and planning, not headlines, to make their decisions. They avoid chasing what's already hot, where they ask, does this move align with my goals, or am I just following the herd? Herd mentality feels safe, but in investing, it rarely is. Markets reward patience and process, not panic and popularity. So the next time you feel pulled to do what everyone else is doing, pause and ask yourself, would I still make this move if I couldn't see what anyone else was doing? If the answer is no, that's your signal to stick to your plan. If you've missed the earlier episodes, we've already covered things like loss aversion, recency bias, and overconfidence. You can catch all of those in your favorite podcast app or by visiting our website. This week's blog is also live now and digs deeper into herd mentality, especially how to spot it before it steers you off course. Next Friday, we're talking about anchoring bias. That's that sticky little habit where your brain fixates on a number that may have nothing to do with the real value of something. Have you ever refused to sell an investment because you paid more for it, or you made a decision based on where the markets used to be? Well, that's anchoring, and we're going to talk about how to break free from it. That's it for this week's episode. Next time the markets start moving, or the headlines start buzzing, and you feel that urge to follow the crowd, take a breath and remember this. Your goals aren't found in someone else's portfolio. So stay focused, trust your plan, and resist the noise. Because at the end of the day, it's not about keeping up with the herd, it's about moving forward with purpose. Securities and advisory services offered through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Fixed insurance products and services are separate from and not offered through Commonwealth. The Flanders Group is located at 221 Maitland Street, Bel Air, Maryland 21014. Phone number 410-569-4506. Investments are subject to risk, including the loss of principal. Some investments are not suitable for all investors, and there is no guarantee that any investing goal will be met. Past performance is no guarantee of future results. Talk to your financial advisor before making any investing decisions. The client example presented in this podcast is for illustrative purposes only and should not be construed as a recommendation. It may not be representative of your experience.
1